Okay, let's go ahead and get started. I apologize for the late start. We were having some technical difficulties getting connected, but it looks like we are up and running now. Um, I don't know where to start. Obviously, the last few trading sessions have been extremely volatile, and I think a lot of investors are left thinking about, is this sell-off that we've seen here over the last, call it three trading sessions, the end of the worst, or is there more volatility here to come? Incredibly difficult to try to answer that question, but what I want to do is take a look at which charts am I paying attention to, which specific indicators am I paying attention to help me try to answer those questions. Um, we have what has been a sort of confluence of multiple factors at once coming into play in the last few trading sessions. You had the strength of the US economy that a lot of investors have felt was quite strong. It really gave the Fed room to leave interest rates high to try to tame inflation. However, we saw Friday's job numbers, which really kicked off um, the sell-off here. It gave a lot of investors a second thought as to just how strong is the US economy with job numbers and unemployment ticking up higher. You have kind of the AI revolution that has been driving the markets for the past year or so, starting to show some concerns investors having with regards to whether or not the AI revolution will lead to the productivity gains that the markets are currently pricing in. And then you have Japan raising interest rates, kind of unwinding a bit of a risk, a carry trade that has been in play for multiple decades now. So kind of all three things coming into play all at once have triggered this kind of panic selling we've seen here over the past few trading sessions. And again, I think a lot of investors are asking, is this an opportunity now to buy after this panic selling, or is there more volatility ahead? So if we look at the S&P 500, on yesterday's open, we basically opened up just shy of just above 5,100, which is a prior support here on the S&P 500. We had 5450 as a support level, which was the 50-day moving average. That was broken very quickly on Friday, and then we had that massive sell-off here yesterday. And to answer the question as to whether or not we are near a trading low, we really have to look at the VIX, and we'll take a look at that here in a second. But yesterday we opened up with the VIX at around 55%, which are levels that we haven't seen since 2008 and the 2020 COVID lows. So the VIX opening up at those levels traditionally does correlate with being near a trading low. We closed yesterday, I think the VIX at around 36, which is still arguably quite high. Also levels we haven't seen the VIX close above 36. Also same thing since 2008 and the 2020 COVID lows. So we'll be paying attention to the VIX heavily here over the next few trading sessions and make sure that we understand kind of where things are headed. But if you look at the equity markets here, we've the Nasdaq 100 tagged the 420 support level here yesterday intraday. Intraday had a nice bounce here, opening up today slightly higher from where we closed yesterday. But looking at the markets, looking at price action, looking at history, we generally see a day after a heavy sell-off like we did on Monday. Typically Tuesday involves some form of a bounce. That's my expectation going into today's session. I don't particularly think that bounce will be long-lived. I think that you will likely revisit the lows that we saw here on yesterday's open and potentially lower. Even if we do find stability in the markets over the next few trading weeks, I believe that the next few trading weeks will likely be quite volatile and remain quite volatile for a few weeks. And even if we do bounce higher here, I do expect that we will likely revisit kind of the lows that we hit here over the next few trading weeks. That's the base case that we're currently operating under. The Russell 2000 similarly kind of reached this 195 support level here. our outlook here for the major markets remain largely the same. The equal weight S&P 500 index providing a little bit of protection here because a lot of this, a big portion of the sell-off here has been kind of the mega cap names that have been driving the markets higher over the past couple of years, really. Starting to see that unwind, that trade unwind. So the equal weight S&P 500 index providing a little bit of defensiveness here in this market volatility. We have seen value continue to outperform growth throughout this volatility over the last few weeks and continued over the last couple of trading sessions. And commodities have really fallen through a bit of a floor here. We've seen commodities break to new recent lows here multiple days in a row on relatively high volume. So commodities, we'll take a look at gold and silver here in a couple of minutes, continue to show some downside pressure. High yield bonds, did not come into pressure until yesterday. We actually did not see high yield bonds respond very much until yesterday. The price action on bonds was interesting from the perspective of we see bonds still outperforming the S&P 500, which is important here. That kind of definitely speaks to a flight to safety, a risk-off environment. However, the fact that high-yield bonds price action yesterday kind of remained fairly resilient speaks to the fact that investors are not spooked across the board. They're not selling assets across the board. That they are selling equities, but that money is flowing into asset classes like bonds. So some of the things to consider here as you look at volatility. So VIX yesterday closed at 38.5, actually. Again, highest level we've seen since 2020 and since 2008, the financial crisis. These levels that we're currently at in terms of the VIX, especially if you consider the fact that intraday, yesterday we did get as high as 65% on the VIX. These numbers typically do correlate towards being near a trading bottom. However, like I said, these spikes in volatility, while typically do correlate with the trading bottom, we do many times see, in the following weeks after these initial spikes in the volatility and a bit of a trading bottom, that equity markets do eventually in the next few weeks revisit the lows that we have put in. So that's roughly 5,100 on the S&P 500, about 420 on the Qs for the NASDAQ 100. Those levels, expectation is potentially for a bounce here over the next few trading sessions. But potentially still revisit some of these lows after those bounces. So, to try to answer that question, a lot of investors are asking is, do you buy, on these lows? I think that it's probably more prudent to be a little bit more patient here and see how markets play out here over the next few trading sessions before you go full on buying in this particular market. And if you're going to buy smaller amounts first before you kind of go full size in your positioning. 10-year treasury yields did recover a little bit yesterday to 3.83%. We did get low as below 3.7% here on Friday. So treasuries is kind of a big response at the moment. You have TLT breaking out to new 52-week highs above that $97 double top here. That would certainly be a continued bullish signal here for bonds. However, this could potentially start to see a little bit of reversal here back into the trading range over the next few trading sessions. So pay attention here. I don't necessarily know that you have a true breakout here for bonds. Dollar index, we talked about this 104.50 as the 50-day moving average acting as resistance last week, and that's exactly what we got. We were just a few tenths of a percent away from that resistance level. We've sold out pretty heavily here. 103.50 is in the support level here that has been broken. So any rallies into that 103.50, I do think is an opportunity for further downside here for the US dollar, given the expectations for interest rates for the US dollar. You have gold remaining volatile, but holding kind of around this 2450 recent all-time highs, right? So we kind of tried to break out once, tried to break out twice, but so far we are managing to hold this 2450 support level here. This is really an opportunity for gold as a safe haven asset to start performing here. Given the kind of the central bank demand we've seen out of gold, given the geopolitical tensions, given the risk-off environment, I think this provides a tailwind for gold to outperform. Whoops, you do have oil kind of holding this $72 double bottom support here for now. We'll see if that holds. You know, if you think about the geopolitical tensions here in the Middle East and what that means for oil, it certainly has the propensity of potentially bouncing from here. I think that we have reached what we consider typically oversold conditions near a support level. This would certainly warrant potentially looking at some long opportunities within oil or oil-related stocks. And then looking at the overall sectors, you know, what we have seen is a pretty substantial decline in terms of rotation out of technology over the past 3 weeks. We have seen a pretty significant underperformance of this sector relative to the S&P 500. Considering we're talking about the best performing sector in the S&P 500 for the past few years, the fact that it's lost 10% of relative performance in just 3 weeks is monumental in size. You have that in technology. You also have consumer discretionary losing quite a bit of ground here, only about, in this particular case, less than 5% of relative performance to the S&P 500. You have communications, on the other hand, gaining quite a few percentage points, about 5% over the last few trading sessions. So communications outperforming the S&P 500 on this particular sell-off. Financials also outperforming the S&P 500, even though it gave back a little bit of that in the last couple of trading sessions. Consumer staples, one of the big winners from a relative performance perspective, basically trading sideways as the rest of the market sold off here. Consumer staples, one of the sectors that have seen inflows as a result of the outflows from technology and discretionary. Healthcare, also another sector that has seen quite a substantial amount of outperformance here. So the rotation that we've seen here out of tech hasn't been a across the board selling across all sectors, and that is part of what gives us more confidence in in conjunction with what we saw in the VIX yesterday. A little bit more confidence in saying that this is not likely to result in further panic selling that's going to send markets another 10, 15, 20% lower here. We're not seeing selling across the board as violent as things have been over the past few trading sessions. Selling hasn't really been across the board. It's been selling in specific sectors that have maybe overshot it to the upside. And now, as we've been talking about the fact that we need to see the rest of the market play catch up, well, that's sort of exactly what we've seen here. If you look at the relative performance here of these sectors, what that shows you is that the money that's flowing out of technology is flowing into other sectors like healthcare, materials, industrials. Note this outperformance here over the past few trading sessions in the past 3 weeks is really substantial. I honestly can't say that I've ever seen, this level of outperformance. Look at real estate; it's outperformed the S&P 500 by nearly 12% in just 30 weeks. I don't think you'll ever find another period in history where the real estate sector has outperformed the S&P 500 by that large of a margin going back. So, the downside that we've seen here in equity markets have not been across the board. And the fact that you see so many sectors, not just a few sectors, so many sectors. We're talking about, you talk about financials, you talk about consumer staples, communications, healthcare, industrials, materials, real estate, utilities, all outperformed the S&P 500 by margins that we really have not seen ever before. speaks to the fact that the sell-off is largely being contained to the excess sectors that have effectively overshot it. Think about AI, the AI revolution that have driven technology shares to be trading at such high multiples. You're basically seeing that unwind right now and seeing that capital flow into bonds, flow into other sectors. It's not a across the board sell-off that you typically would see with if you're concerned that things are going to get far worse from where we are right now. It doesn't mean things can't get far worse. They absolutely can, but so far that's not quite what we're seeing yet. So with the VIX trading, peaking at that 65, you look at the price action, the rotation that we're seeing. I do expect in the next few trading weeks, we are going to find a trading bottom here in equities. I don't know that we're there yet, but I think over the next few weeks, we'll likely find that. So that's the base case that we're currently operating under for the equity markets for those of you that are obviously concerned and asking questions as to what should we be paying attention to help decide when should we step in as buyers or should we be looking at selling, further selling going forward. So hopefully that gives you a macro view from um, a macro view, a bit of a step back from what the we've seen in terms of the markets over the past few days. I know things are quite emotional right now because you're probably seeing some pretty substantial swings in the P&L of your portfolio, whether you're long or short, and you're trying to figure out how to navigate this. My advice to you is take things one day at a time, focus on looking at the VIX and kind of how that's responding to the overall markets. We tend to see VIX calm down, around market bottoms, and that's sort of what we're seeing here over the last couple of trading sessions. We need to see that continue to have a little bit more confidence in this market. But like I said, even if VIX bottoms yesterday, well, historically speaking, we generally do see equity markets recover in the short run, but then revisit kind of the lows a few weeks later. So that is still our base case, even if the VIX kind of effectively peaks on yesterday's move and starts to kind of recede in terms of expected future volatility. I do expect that over the next few trading weeks, you will see a lot of chop, a lot of sideways price action, volatile sideways price action, I should add, given kind of how history has generally played out in these types of environments. So with that, hopefully that gives you a better understanding of kind of how we're viewing the macro picture here right now, giving you a little bit more a view into how we're looking at the outlook. And I will update you again next week on how things play out. So with that, I hope you guys have a great trading day. I apologize for the late technical start, but at least we were able to get through everything and make sure that you understand how we're viewing the markets. So with that, thank you so much. I hope you guys have a great trading week, and I'll see you guys here next week on Tuesday's Market Outlook session.